mortgages and the cost of living crisis. In this video, we're going to talk about how to take back control.
Inflation and cost of living is probably the most talked about topic in the news. All of our bills seem to be on the rise. So you've got your energy costs, you've got your fuel costs, you've got your food costs, and you even got your Sky bill.
Most people are constantly reviewing those smaller bills. However, your mortgage is your biggest debt. There are a number of ways to limit the increase in your mortgage costs, and in this video we're going to look at how to do that.
There is a lot of financial instability in the UK and interest rates continue to rise. We don't know when interest rates will stop increasing.
The first thing that you can do to prevent those rises is to look at a fixed rate mortgage. Now, when it comes to a remortgage, the earliest time that you can look at that is up to 6 months before your deal ends. Lots of people leave their remortgage right till the last minute. By looking at it as early as possible gives you loads of options. The first option is you can lock in the rate early. So if interest rates continue to rise, you've locked your rate in while those rates were at a lower point. The other benefit of starting the remortgage process earlier means that if your mortgage is declined by that lender, is you then have got options to move to another lender in time for when your mortgage comes off the fixed rate deal. The other benefits of looking at a fixed rate deal is you can fix your deal for a certain length of time. So typically lenders offer 2 or 5 year options. A 2-year option gives you stability for those 2 years. So if interest rates do change, you won't notice any changes in payments. A 5-year deal, however, gives you a little bit longer stability with your mortgage payments. So if interest rates continue to rise, you know that your mortgage is fixed for the next 5 years. There are also lenders that are now coming to the market that will offer even a longer term than 5 years. So some lenders offer 7 years. There are some lenders that offer 10 years. There are even lenders now that will offer to fix your mortgage for the whole term of your mortgage. And that's something that people are now looking to consider based on interest rate rises. We do get asked regularly by clients that if they start the remortgage process 6 months before the mortgage deal expires and interest rates drop in that term, what then happens to their mortgage? Well, the good news is the lender will allow you to change your mortgage product during the process up until completion. So if rates do drop, you can move on to another product. However, if rates increase, you can stay on the product that you chose 6 months prior, knowing that you've got a good deal.
Although fixed rates might be priced high at the moment, there are other product types available that may offer a lower monthly payment. So these are certain tracker and discounted products. So your tracker products track the Bank of England base rate. So for example, the base rate might stand at 2 or 2.5% at the moment, and it'll be a certain percentage above the Bank of England base rate. There's a gap between the actual payable rate a tracker product gives you versus what a fixed rate is payable at this present moment in time. The issue that you may have is that although the tracker products give a lower payable rate at this present moment in time, if the base rate continues to rise, that will become more expensive than any fixed rates that are available currently. Now let's talk about the discounted products. So discounted products are a discount off the lender's standard variable rate. Now, the lender can increase their standard variable rates at any time. So they may increase it or they may decrease it. So we're never really in charge of it whatsoever at all. And you may not know from 1 month to another if they are going to carry on increasing the standard variable rate. Although it may offer you a discounted product initially and a lower monthly payment, over the coming months or over the coming years, the interest rate might increase significantly, therefore becoming more expensive than any fixed rates available. Another way to reduce your outgoings and to keep your bills down is by switching from a repayment to an interest-only mortgage. Now, we don't normally advise this at all, and this should be considered really as a last resort. An interest-only mortgage is simply put, you just servicing the interest on the mortgage and not paying any capital down. So for example, you might have an interest-only mortgage, which is for $100,000 over 25 years. Now, it's your responsibility to make sure at the end of the 25 years that there is a suitable vehicle in place to repay that interest-only debt. An alternative to having the mortgage fully interest-only is by having it partially interest-only and a partial capital repayment basis. That will still give you a reduction in your outgoings, but once again, it is your responsibility to make sure at the end of the mortgage term, you have to pay that interest-only debt back.
Another way to reduce your mortgage payments is to increase the mortgage term. So you may currently have your mortgage over 20 years and let's say, for example, your retirement age isn't until the next 30 years. A mortgage lender may increase your term by those 10 years to take your mortgage term up to 30 years and therefore reducing your mortgage monthly payments. Again, you do need to carefully consider increasing your mortgage term, as with any debt, the longer the term the debt is over, the more interest that you will pay back in total. Another way to reduce your monthly outgoings when it comes to a mortgage is to look at debt consolidation. Debt consolidation is where you have a number of debts in the background, for example, loans, credit cards, car finance, mail order. What debt consolidation does is it encompasses all of those debts into one monthly repayment with your mortgage. By encompassing all of those debts into one payment, you may be able to reduce the interest rate that you're paying on those debts and also increase the term that those debts are over. We've had lots of instances where we've saved clients hundreds of pounds each month by putting debts onto their mortgage. However, again, this needs to be taken into careful consideration because adding those debts to your mortgage means that those debts then become secured against your home. And if you don't meet your mortgage repayments, your home could be repossessed. Also, again, those debts may only be over a 3 or 4 year term, and by adding them to your mortgage over, let's say, a 20-year term, may mean that you pay more interest back in total.
Another way to reduce your monthly expenditure is by potentially making a lump sum overpayment on your mortgage. Now, you may have built up some savings over the years that might be sat in a savings account. As interest rates are rising on the mortgage, the interest rates aren't actually being passed on to savers, so it might be wise to make a lump sum overpayment on your mortgage. This could potentially mean that you qualify for a better loan to value, mean that you may qualify for a lower interest rate, or simply put, it might reduce your outgoings on a monthly basis.
Having a mortgage broker that can access a comprehensive range of lenders is really important at this time. By going to a bank, the bank can only offer you their products, and currently lots of lenders are changing their products on a regular basis. There are even lenders that are withdrawing products from the market. If you've got a broker that's got an access to a comprehensive range of lenders, if that happens with that particular lender, your broker can quickly switch your mortgage application to another lender. If you are struggling meeting your current monthly mortgage payments, or you're worried when your mortgage comes off its deal that you're not going to be able to maintain your mortgage payments, it's so important that you approach your current lender as soon as possible. That lender will hopefully be able to give you some advice on how to meet your mortgage payments, or may be able to help with certain things like mortgage payment breaks. If that lender isn't able to help, it's then really important that you reach out for some external debt advice. There are a number of different providers available, such as the Citizens Advice Bureau, that can give you free independent advice on your mortgage. So there you go. The cost of living doesn't need to be all doom and gloom. There are certainly a number of options available to you that may be able to help you with your mortgage.
So one option that we discussed was debt consolidation. Check out this video on how we saved this client £18,000 a year through debt consolidation.